I'm Larry Kalvik, founder and CEO of the Haven Financial Group. And again, thanks for listening this morning. Every week we talk about retirement topics, the economy, what's going on, things to do and things not to do. And Kim, every week we have certain new things that we want to talk about and help people with. So I encourage the listeners to call 612-504-8400 or visit us online at havenfinancialgroup.com. All kinds of retirement tools, classes. Yes, I know it's the end of the year. Holidays and Christmas are here. So we do slow down a little bit, but we get right back at it after the first of the year.
Absolutely. Well, Larry, it's great to be with you like always. And I understand that we have a guest today. Lance Larson from the Haven Financial Group office is with us. He's a certified CPA, and we're sure glad to have him with us because today we're planning to talk a little bit about estate planning. You know, Larry, as you get toward the end of the year, this is that time where you sort of button things up. And I think estate planning is one of those things that you put off. And when you get to the end of the year, it's almost difficult to keep putting it off. You have to, start to make some plans and make some decisions about when you're going to tackle that. And maybe that's right now, or maybe that's right after the first of the year. Maybe that's something you want to do in 2025. But we're going to talk about the importance of tackling it at some point. We're going to start by talking about gift tax rules and how they work, which is something very important at this time of year. We're going to talk about strategies to reduce gift and inheritance taxes. We'll talk about key legal documents for an airtight estate plan. And then finally, we're going to wrap up the show by talking about what to know about inheritance retirement accounts. So full show, lots of great information for everyone. And we're certainly happy to have Lance with us today.
Thanks, Kim. It's great to be here.
Absolutely. I know that you know a lot when it comes to estate planning and everything associated with it. But could you just talk in general for us here, Lance, real quickly, why you urge people to really tackle this issue, even though maybe it's not one that's so fun?
So estate taxes to me is probably one of the most morally indefensible taxes that our government has put on the public here. We work hard all our life. We pay our income taxes. We have our take home pay, and then we're frugal with it. We do good planning with it. And then just because we've done a good job of saving all our money, we are over this threshold and we have to then give a cut of it back to the government. It just seems really wrong to me. And so that's why I want to talk to a lot of clients about making sure we don't hit those thresholds. That most people, when they pass away, they want this money to go to a specific cause, person, family member. Those people should get that money full out and not just a portion of it after the government takes their cut. So that's one of the biggest reasons why we want to do estate planning, is make sure that all our beneficiaries get the full amount that we want them to have.
Larry, I think it's pretty rare that people in their wills or in their estate planning that they want to give it to Uncle Sam.
Yeah, I'm sure.
He's not usually a beneficiary, right?
Yeah, well, oftentimes Uncle Sam, not your favorite uncle, is the beneficiary. And if you don't do some estate planning or tax planning, that might be the outcome, and the outcome that you don't want. This show, Kim, is going to be, we're going to talk estate planning later. Those legal documents, what those look like. But a big chunk of it, especially the first two segments, are going to be about taxation of the estate on a federal level, on a state level. And we're here in Minnesota. Each state has some different guidelines. But I know as humans, what we're good at doing is putting things off that we should have done. And many listeners might get a chuckle that they know they should have been done the estate plan 20, 30, 40 years ago, and they still haven't gotten around to doing it. Professional procrastinators is what I had a couple in recently. They go, we should have done this when our kids were born. Now our kids are 45 and we still haven't done anything. Mm-hmm. There's still time to do it. Don't wait till it's late. Don't wait till it's too late to do anything, because then it's not going to matter. And your loved ones or heirs or whoever's you want to benefit, now they are going to have to do all the legwork.
So, Lance, let's talk about some of the ways that you can leave your legacy, maybe to your family members, like you said, or to an organization, whatever it might be. How can you do so in the most effective way without them having to pay taxes, like an annual gift, for example?
So there's a combination of two methods that we want to look at to make sure we pass money on to our beneficiaries without having to give the tax money to Uncle Sam. First one is that for Minnesota, we want to make sure that we are under a $3 million total value of the estate. As far as Minnesota goes, we have to be under that 3 million in order to not pay any taxes. There are other states that actually have a little bit higher thresholds. Like I know, I believe New York has like a $4 million, and there's so on and so forth. But that's the biggest thing we want to look at there. Then we can look at trying to gift that money on an annual basis. Each person can give up to $18,000 here in 2024, $19,000 in 2025 to any individual, and without having to do any type of reporting and any type of gift tax on that at all. And so we start delving into that strategy right there. You can look at a married couple. Well, then if a married couple is going to do it, then this year they can give $36,000 to an individual. If they have a child that's married, well, you can give then $72,000 to that couple because mom gives $16,000 or $18,000 to child, dad gives $18,000 to child, mom gives $18,000 to spouse, and then dad gives $18,000 to spouse. So that's the $72,000. Then you can even multiply that more by children that or grandchildren that are there. So we can do a really big gift every year without triggering any type of filing requirement. And that's probably one of the biggest strategies we have if we're trying to reduce estate taxes.
Now, what about federal taxes?
So the federal level right now is not too much of a concern. Federal level is actually going to be about $13.5 million right now, almost $14 million for 2025. If individuals are getting up into that and needing to talk about that, we definitely can do that. But most people, we're not typically dealing with that dollar range right there.
And Lance, what do you do if your estate is worth 3 or maybe 5 million, but a lot of it's tied up in assets versus cash, so it's not so easily distributed like that?
Then we can start doing things as joint tenants, getting ownership transferred over in that manner. I had a client at one point who had a family cabin, and they were able to put that in a family partnership where mom and dad owned 100% to begin with, and then they started bringing their child in, and then every year they would transfer over units of that family partnership over to the child there. And they were able to do that for many years until the child was able to have 100% ownership.
So I would imagine that there are a lot of people who are listening right now, and maybe they're thinking about just that. Is there a way to avoid taxes on real estate? Maybe something that we want to keep in the family, but we want to transfer that. And I think you've explained that. And I would imagine there are lots of other ways in which to go about this if you start it early enough to avoid some of these taxes, correct?
Yeah. There's a lot of one of the biggest things that we're trying to accomplish here is that we want to get these transfers done over time because we have these small thresholds without having to report it. It's kind of the same idea of investing. You want to invest early and let the element of time take care of all the growth there. We are limited to when someone passes away. Once you pass away, you can't give away anymore. It's all into your estate, and then the opportunity is lost.
Yeah, absolutely. So,
Yeah, Kim, and if I could add, what we want people to do is look at all the options. If this is applicable to you, to look at all the options and weigh all the options from a tax perspective. If you're wondering about real estate, typically if you have a good estate plan, a trust or something, that will pass at the stepped up basis, avoiding a lot of that capital gains tax.
right.
Other things like contributing for education and medical gifts, some made directly to those types of institutions can be very beneficial and exempt from some of the taxes. looking at all the options, weighing the options, and this is applicable to in different ways to different people. And you say, well, I don't have anything close to 3 million or 6 million, and these are only big numbers. I don't want anybody listening to think this is only for the rich people.
Right.
Estate planning and tax planning is for the rich and for those that don't have nearly as much. So please don't take that as, oh, this is only for rich people today. Not even close.
Absolutely.
If I can chime in also, just
Sure.
piggyback on what Larry says, that this is for everyone. Having a competent estate plan is more about making sure the assets go where you want them to go. Most of the time, parents want things to be split equally among their children.
Mm-hmm.
Well, that's all fine and dandy if that's your plan. But if you don't have your documents set up to do that, then everybody has to follow what the documents say. Mm-hmm. I've had a couple different clients come in there where the children were supposed to split everything 50-50, but mom and dad unfortunately didn't have 50-50 set up on beneficiaries on some IRA accounts. And so when you look at the total estate, what happened was that child number one ended up with about 80% of everything, and child number two ended up with 20%.
Sure.
Now, fortunately, in both cases right there, the siblings were on good terms, and they were able to work out something equitable between the two of them so that it was more 50-50. But imagine if those siblings were not on good terms and that one gets way more than the other, and that's just going to cause even more division between the siblings right there.
Yeah, absolutely. Yeah, there can be so many outside influences associated with this. Larry, you and I have talked about this many times. You know, money and estates can really do away with family relationships very quickly. And I think most parents don't want that to happen. So the way to do that is to have things set up before there could possibly be any kind of problem. 612-504-8400. That's the number. That's how you reach Haven Financial Group. If you're listening right now and you know that you don't have an estate plan, or maybe you're not too pleased with the taxes that you're paying and you know that you need to do something about it, this is the number to call to set up a free consultation. 612-504-8400. By the way, don't have to just be looking at your estate plan. You want a full retirement and estate planning proposal, and then ultimately that be your guide for your retirement, as well as we've said, your tax plans, and then ultimately your estate plan. When we come back, we want to talk a little bit more about the gift tax rules, how they work, and what to do with them.